2016 is shaping up to be another tough year for transportation stocks. Some experts are even referring to it as a freight recession, including CSX chief Michael Ward, who on a recent earnings call used the term to describe the headwinds pressuring so many of the railroad's markets. And CSX isn't alone. Today, Union Pacific stock hit its lowest level since February of 2013 after disappointing earnings and downbeat commentary. After a, quote, very challenging 2015, that railroad is not releasing earnings guidance for this year due to uncertainty in its markets.
Our perspective is with the strong dollar and with the energy recession in full bloom, there are some pretty significant headwinds to our volumes right now.
Union Pacific CEO Lance Fritz adding that many businesses tied to consumers have been weaker than expected as well, despite the windfall consumers have enjoyed from lower energy prices. That dynamic is emerging in other industries, too. Just earlier this week, the American Trucking Associations said truck freight volumes should be negatively impacted over the coming months because businesses are overrun with inventories and buying less, which means less shipping. Analysts say that's worrisome since companies catering to consumer goods had been holding up better than those hauling industrial products and raw materials.
The concern we have and the bigger picture issue we've highlighted recently is that in the fourth quarter we started to see some weakness in some of the consumer-facing end markets. So if we were to see some of that industrial and commodity weakness spill over into the consumer end markets, that would look more like a mild total U.S. economic recession. So it is something that we're watching very closely.
Still, the hope is that overall freight demand begins to stabilize and recover later this year. But in the meantime, it's a story of weakening financials, plunging stock prices, and in the case of railroads, growing staff cuts. For Nightly Business Report, I'm Brennan.